Well, welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Nick Jones. He's been involved in commercial real estate management, investment, development, and brokerage for over 20 years. During his career, he has underwritten and purchased over 70 commercial investments and or developments, representing more than $250 million in value. Currently, his firm, Alakai Capital, manages a portfolio of over 1 million square feet of industrial, retail, office, and medical office space. His team's mission is to help investors build lasting wealth through real estate that delivers predictable performance, even in unpredictable markets. Nick, thank you so much for being on the show today.
Thank you very much. I'm happy to be here chatting with you today.
So 20 years in the business. Can you tell us a little bit about yourself, both personally and professionally, before investing in real estate and launching your current firm?
Yeah, I actually started, I grew up in Seattle and I moved down to Orlando, Florida after high school to wakeboard professionally for about 7 years. And as a young athlete, I figured I'd be doing that forever. But, as most of us know, your body ages quick. And so by my mid 20s, I was going to UCF. I started looking at, other aspects, other careers to jump into. And real estate has always been attractive to me. And the clearest path to get into was through brokerage. So I jumped in after college with Colliers International and was on the land brokerage side at a time that it was very challenging to sell land. Buildings were still being sold as short sales, as foreclosures. And so there were a few years that I felt like I was probably selling, timeshares, not many buyers. But as the market started to get better, the multifamily developers, the hotel developers, the retail developers started calling back. And I was fascinated by, the way they were underwriting deals, the way they were thinking creatively about investing. Some were doing quicker deals where they'd reposition some of the land, sell it off and develop other parts. Others are going all the way full cycle. And from that really got drawn into the idea of being on the principal side of things. So after a few years of doing brokerage, I ventured off my first deal, and it was a small retail deal. And then, had some success, had some great tailwinds of the economy behind my back and continued to do, more deals, then started to build a team behind it. And, looking back 20 years, here we are today.
Do you think brokerage is a good way for people to get involved that want to have maybe the ultimate of being a real estate investor in commercial, getting in on the ground floor really with a brokerage?
I think brokerage is a really strong way to get involved. You learn each player's position within, a deal within the market. You learn about the tenants and what their expectations are, which is very different than any other type of real estate. And you kind of can hear how everyone talks about the lingo, how everyone looks at deals, underwrites them. So it's a great first step. I will say just getting into brokerage doesn't result in being able to transfer to the principal side of things. I spent a lot of time, at nights and weekends studying, a lot of time with online classes to get to my knowledge to where I can make that transition, where brokerage was a way in the door, but it still took, a lot of extra effort that wouldn't, be necessary for just brokerage.
When I started buying multifamily properties, one of the things that was much easier to work with brokers, agents that had some sort of background in the investment portion of it, because it was just much easier to work with them. Even if you're buying smaller, like residential style, smaller multifamily 1 to 4 unit type stuff or 2 to 4 unit stuff, it was easier to work with someone that kind of has done that before and had an idea of what you kind of questions, what was going through your head as you were walking the property. And if they were very good, they would already do a little bit of research on that beforehand. And then moving into more commercial, I've never worked with brokers before that were really involved in investing. You know what I mean? You have a lot of people that kind of take the path of being just a broker. But then I have found some older brokers that I've gone to and they've been very successful, which kind of going into that investment round. So it's a very interesting way of getting into the business while still having it checked, because obviously when you're investing in real estate, these deals don't cash flow right away. You know what I mean? And they're not going to be that much. You got to do a lot of deals to be able to, cover your expenses.
You have to do a lot of deals. I think people misperceive how much is made on a deal. And, I've known quite a few brokers who have gone on the principal side, on the development side, and then they went back to brokerage because, the risk, the different profiles, aren't as rosy on the principal side. I mean, everything that you make has a string attached to it, whether it be, with a tenant, with a lender, with investors. When you get a brokerage commission and it's in your account, it's, you can do whatever you want with it. So it's a very different way of looking at it. And some, think it's great to try, and then they go back and they like the idea of the risk freeness of brokerage.
I also found it too on the residential agent side. There's very few I have found agents that I've met that actually have a portfolio. Maybe they have one house here or there or something like this, but not many of them that I've met before that actually have a sizable investment portfolio. You know what I mean? There's very few that actually go that route because it's they already started one business really by becoming an agent. So now they're going to the other side again. So
yes, it's hard to balance both. But I have noticed the ones that can speak both languages are the most successful. So, if the broker knows how a developer thinks, they may not choose to be a developer because, maybe they don't even want to do the back of office work. There's just a lot of time you have to spend underwriting deals and going back and forth with municipalities and whatnot. But if they can speak that language and they can look at a deal from every angle, it can make such successful careers just by knowing how each person is thinking that's at the table.
Yeah, that makes perfect sense. Yeah. So kind of give us an overview today of your firm and your current investment strategy.
So our firm, about 15 of us, and it ranges everything from property management, accounting, asset management, development, capital markets, acquisitions. And we are focused really in the space of retail and industrial. And we like both of them for different reasons. So the small bay industrial space we're really fond of right now because we're seeing a lot of inefficiencies in the market with sellers' expectations on rental rates and where we're able to adjust the parks with, sometimes we have to come in and do a good amount of capital improvements to the roof, the facade. But other times, it's just marking the tenants to current market rents. And a big reason for this is the recent inflationary pressures we've seen across the country, where we've seen rent increases, 10, 20%, kind of cumulatively, probably 30 to 40% over the last few years. And for many longer term landlords, kind of everyone was brought up in the industry that 3% annual increases was standard. And a lot of leases are still that way. So when you've had 3% annual increases and maybe you've pushed a tenant to 5%, but it kind of feels a little high. Meanwhile, inflation's at 10, 20%. There's a large gap between where market rates have, gone to where, sellers have their leases at. So we've been able to come in, renegotiate some of those leases. A big part of it's working with the tenants. Some of the tenants know about this and they're already charging higher pricing to their customers. So they've just been, getting a free ride. And so when we come in and say, hey, we got to, push rents to market, they're very understanding. Other tenants are pretty naive to the changes in the economy. And it takes them a while to, change their pricing. And so then they'll change their pricing down to their customers and their customers will do it to them. So you're almost seeing like the bulkiness of inflation firsthand when you're working on these industrial deals. So we've really enjoyed those. And on the retail side, what we like about retail is that in most commercial real estate, there's really two people sitting at the table, the investor or developer and the lender. In retail, there's three. There's the tenant. Our tenants are some of the biggest in the world. And there is some of this in industrial and some in office, but not generally where we spend our time. So in the retail side, we're building for a lot of these national tenants like Dutch Brothers, Starbucks, Chipotle. We're doing some bank branches as well. And you have an opportunity to talk with the tenant and understand what their goals and objectives are. And as long as we can meet those, we can still reach ours. It creates a good long-term relationship to where you can start to do multiple projects with them. So on the development side, all of our development deals are with these larger national and credit tenants. And the idea is we start to create a system where we can roll out numerous deals with them. So we have one tenant that we have 6 projects that we're going through development on right now. We have another, we have 3. So building those relationships allows us to scale quite a bit. And then we also do retail strip centers. And that story is very similar to the small bay industrial, where there's been a mismatch of rents relative to inflation in a lot of the markets. And the benefit that we see in that is we're actually able to add a lot of value, more than on the industrial, by doing the facade renovations, by updating the parking lots, by changing the signage in the storefront. Because an industrial user may not care as much when you're doing those kind of finishes, but the retail users very much notice it and they appreciate it. Their customers appreciate it, even if it's just subconscious. When customers go into like a newly renovated center, it just feels better. It creates more alignment with what the retailers are trying to do, and it helps them with their sales, which then helps us get our rent payments in.
What would you say are some of the pros and cons of, say, retail investing versus small bay industrial investing? Why do you like them, and kind of how does it trickle down to your end investor?
So the One of the biggest pros of retail, as I mentioned, the tenants are a strong aspect of it. That can also be a con. I mean, these tenants are very strong negotiators, and they're very knowledgeable on what market rates should be, on what construction costs should be, on what land values are. So those deals tend to be a little tighter because you just have very intelligent people on the other side of the table when you're negotiating. Also, the longer term leases that you sign, once again, it can be a great thing, but in inflationary environments where you're locked in for a 15-year lease with 5-year options, you're not going anywhere. Regardless of how much inflation there is, the rent's staying per that schedule for a very, very long time. Where on small bay industrial, you're doing sometimes 12-month leases, on average, 3 to 5 year leases. And so you're able to bump those rents a little more, but you're also dealing with more, local mom and pop type tenants. So that comes with its own, set of just risks and variables. But I will say what was fascinating for us was during COVID, we had a mixed portfolio of, credit, larger tenants and local tenants. And when, things kind of hit the fan and everyone had no idea what was going to happen to the world, the larger tenants were the ones to stop paying rent. And they just said, hey, hold on, let's figure out what's going on. Let's not pay rent if the world's ending. Where it was the small bay industrial tenants, the more local guys that, maybe it was, someone has 5,000 square feet and he grew his business, or, he's second generation, that would call us and they'd say, hey, we know that things are tough. In some states, like in Seattle, I don't think they were able to work. And they'd call us and say, we're going to get rent in on time. We're working on the weekends. So we're going to figure this out together. And so there was a lot of comfort in, the more personal type tenant relationships that provided, because of course, we still had to pay our debt. No one forgave us, of paying our debt payments. Some lenders converted to interest only, but it was still a very challenging time because we were kind of stuck in the middle between tenants that couldn't open and, lenders who needed their mortgage payments.
Has that changed your perspective at all on working with national tenants? Maybe I know you do the development portion of it, but having them as when you're going in and maybe repositioning or renovating a property with the goal of renting it to a high credit national corporate tenant, has that changed at all because of what happened during COVID? Or is it just kind of, you just have to deal with it?
Well, COVID was a black swan event that, you talk about, you hear about, but you never really expect. What we got out of it was that the unexpected can happen very quickly, and to really take our reserves seriously for events that may be out of the ordinary. So we put a lot more effort into underwriting what our reserves, the time period we can hold a property, if certain tenants blow out, what that looks like, so that then we can be more strategic if something goes wrong. Because also during COVID, several tenants had to close down, while others, were deemed necessary and they were able to stay open. And a lot of the tenants that stayed open did very well because, people didn't have many places they could go. So it definitely had a perspective of risk adjustment. As far as the tenant type, I wouldn't say COVID was a big factor in that. I mean, we've had some issues with all kinds of different tenants. And with the credit guys, you really just have to make sure that everything you put in writing, because it'll be, per the law of the lease. So if you don't deliver a project on time and there's a penalty, that tenant will smile and they'll be friendly with you, but they're going to charge you that penalty every single day that you're late. Where on a local tenant, there's a little more flexibility, and sometimes they may not read the whole lease. And so it's a little more of a hand-holding relationship. So you have to make sure that you appreciate the person that you're signing that lease with that's, coming into your space.
What do you usually see with your small bay tenants, industrial tenants that are renewing? Like what kind of percentage do you see that continually are renewing if they have a 12-month or a 24-month lease with you?
So what percent do we see renewing?
Yeah. How high is that?
After we come in and we fix the properties up and start to build the relationships, they're pretty high. Industrial's still been in the states that we invest in, which has been Seattle, Washington, Texas, and Florida, have been pretty strong industrial markets. And when we've had tenants not renew, a big part of it is because they're expanding, and we'll try to have them expand within our parks or move them to another park that we own, or they just they won't be able to fit and they'll move somewhere else. But generally speaking, I'd say our tenants have been pretty stable and pretty open to the 3 to 5% rent increases that we're seeing on industrial small bay right now.
So you talked about some of the markets that you guys focus on. What could you say are some of the key drivers for choosing a market?
The largest historically for us has been a deep understanding of the demographics and the movements of the market, as well as relationships. So Florida's been our backyard, and that's where we started to build our relationships initially. And that's why it's been 75% of our acquisitions and developments within the state. We've started to expand outside Florida. And as we've done so, we are choosing markets that have a level of liquidity in the exit investment that we're comfortable with. And we saw this firsthand when we bought a deal in Ohio, and we followed a tenant up there who was a strong tenant of ours down in Florida, found a building, put them in there, renovated it. And then when we went to go sell, we realized that the buyer pool for that property in Ohio was, maybe people within the state of Ohio, maybe people within that city. Where when we invest, right now we have some deals in, as I mentioned, Texas and Florida. We have buyers from all across the world. So every continent, more or less, there's a buyer that's comfortable in those markets and understands them. And so that provides a lot of liquidity on the backside. When you sell something, it really comes down to, does your price align with market expectations? Not, is there a market for that asset? And so with how many deals we're doing, we do about 10 to 15 deals a year. Having that comfort that, when we do decide to sell, there's buyers out there is powerful for us. We're clearly looking at demographics as well. So, the states we invest in are generally ones that, you're seeing population growth, you're seeing income growth, education growth. Those are three bellwethers that if you have those, at your back, and you can invest at a good basis, you're probably going to do all right long term, regardless of hiccups that you may have in the property. At least a lot better than other states where you're seeing out migration.
Yeah, it's very interesting. I didn't think you were going to answer that with having the buyer pool of the property. So that was unique. What I was thinking. But what would you say for key parameters must a deal meet before you guys begin your formal due diligence? If you're doing 10 to 15 deals per year, you're looking at hundreds of deals. Kind of like what happens in the beginning of that funnel that gets it down to a formal due diligence?
Yeah, the first few things we look at is first, does this property fit within the market? What it currently is, or what we're looking to do to it, does it just make sense? Does the access make sense for the use? Does the visibility, does the layout, does it just make sense from a fundamental real estate perspective before you dive into the details? When the market was really hot back in 2021, there was a luxury that some people could do good deals on bad real estate. In today's market, I think you have to have good real estate and a good deal to really make it have sense and to really have the risk be worthwhile. So first of all, you just want to see, does the real estate check the boxes of the location, the visibility, traffic counts, things of that nature. And then does the building have any oddities that would make it a challenge if our plan went wrong? So if we're buying something existing, we want to see what's the ultimate downside risk that we see potentially happening, and how can we mitigate against that? And is that a crippling for the project? And once we kind of get from those perspectives, then we start to analyze, the upsides. And where can we really add value? Where can we create alpha on this deal? And then if that's asymmetrical to the downside risk, we start to get really excited about it and interested. So a lot of times, like you said, we're looking at hundreds of deals, maybe over 1,000 deals a year. And the first things you cut out are just the things that, have just too much hair. They're too unique. They're in a funky market. The building's kind of off the beaten path a bit. Things like that, where just maybe a local, group that is doing less deals, may be able to figure out. But for us, it's just getting certainty of success and, reducing the risk as much as possible. So obviously, if you have one bad deal, it sets you back quite a bit. It sets not only, the sponsor back, but it's also a challenging conversation with investors. And, that's who really we're looking out for. That's who our fiduciaries do. So we spend a lot of time just vetting out kind of the junk to get to some gems each year.
No, that makes perfect sense.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
When you guys are doing like lease up phase, let's say of a small bay industrial property, what kind of, do you put that out to a broker to find your tenants? Or what have you been successful in doing during that phase of, if you have any vacancies, how are you renting them during the marketing process?
Yeah, we are very broker dependent. We've had such phenomenal relationships with our brokers, and they've been by our side to help our company grow. So when I look back on, I think every single deal for the last few years that we've bought has had a broker involved. A broker generally, sharing it with us, whether it be on or off market. And then through the leasing strategy, we have our leasing brokers involved. And we even have our exit, our investment sales brokers involved. So the second that we see a deal that we think is, worth looking at, generally if a broker brought it to us, we'll ask them, what they think the strategy is. Then, we'll verify the lease rates in the market with our leasing brokers before we even close. A lot of times before we even have it under contract. And we'll even call our investment sales brokers, outline the deal, share the location, let them know what we're thinking about it. And they'll give us their feedback on if we were to sell it in, 12, 24, 36 months, where they think the market would be. And, of course, these are all just opinions. The markets are changing drastically. But, each one of these individuals all day, is just working on investment sales, or all day is just working on leasing, or, bringing off market deals. So their insight is very granular and is something that, we've had quite a bit of value on. When we have it under contract, we'll start talking to the tenants. If there's tenants that we know of in the market that are looking, we'll start talking to them as well. Ideally, we get a few leases signed or, some warm renewals from existing tenants while under contract. Because once again, we're always trying to mitigate risk before we close. And even after closing, get leases signed as quick as possible. So, we have an investment thesis, of course, when we put a deal together. But, we're not naive to the fact that if we have a vacancy and we have a tenant coming, to our table to negotiate, every single month that we spend negotiating costs us money, right? It costs us money where we're not getting returned to our investors, where we're having to pay, a mortgage, we're having to pay CAMs, because it's dead space. And so, we're trying to get tenants in there as quick as possible. And the quicker we get a tenant and we can negotiate, the better deal we'll give them, just because we're fine sharing with that, to build that relationship with them.
That makes perfect sense. What has $250 million in transactions taught you about risk?
I think risk is one of the most misunderstood aspects of investing. And I constantly see that most investors are overly optimistic. If they're not investing, then they're, generally pessimistic. But to be an investor, you have to be optimistic in general. But you really have to get to a point that you can measure risk. And a lot of people, as they get better at a certain thing, or they do more volumes of it, so like real estate investing, they may go the opposite way and have it be more of a feeling, where we have gone the direction of underwriting our risk to be more detail oriented. So we've started to quantify our risks into checklists, into various things we do for every single property, just to make sure we're turning over every single stone. And we also, after we have a successful deal, analyze and we say, did we get lucky on that deal, or did we actually make the smart decisions? Because there's this notion a lot of people have that when they are successful, it's because they did the right thing. And it may just be that they were lucky. And hey, if you're lucky and you have a successful deal and make a ton of money, that's awesome. Great for you. But if you fail to recognize that and you get lucky on a few times, then you let your guard down. I mean, that's where we've seen it time and time again. Then people start to waver on their, risk analysis. So on every single deal, we have checklists as we go through each process of the acquisitions process. And, we're outlining everything we think that could be a risk, so that it can be pretty quantifiable. Because in real estate, you can measure a lot of the dynamics. Some Some are more challenging, like market movements, but you pick your locations, as we mentioned before. You pick your states that you're investing in, so that hopefully you have the tailwinds of the economy at your back.
No, I had a mentor one time tell me that just because you made money in a deal doesn't mean it's a good deal, and it's if you start thinking about that and go back through all these different deals, you start. I mean, without even going to numbers, just knowing kind of the hair that was on that deal, you know what I mean? You kind of go back and you're like, that one was a little aggressive. You know what I mean? And how do you really distinguish that from the strategy, from the luck? Is there something where, I mean, if you're working through checklists now and everything like that, so like it's a huge different story. If you have your standard operating procedures and make sure everything checks before it goes. But what have you found before where you had to kind of distinguish luck from strategy with deals that maybe made money, but maybe weren't the smartest deals?
So the area that I've seen where we have had the most challenge underwriting risk has been with non-credit tenants. So tenants that are growing, that have various and they may have dozens of locations, who appear on the surface that they're doing everything right, and in the financials there are potential questions that are unknown, or the financials aren't being shared, and over time there can be cracks in their business model, or they can be expanding too quick. There can be turnovers of executives, whatever it may be. And we've been able to keep up on that. We definitely try to build relationships with our tenants, understand what they're doing. We follow the news on them. And, we've been lucky enough to exit some of those deals prior to, anything possibly coming to fruition that could have negatively affected the investment. But we have had some where we've been caught. We've had a tenant that we thought we underwrote properly, and their business model failed. And so we had to deal with the costs of, repositioning that space or that property. But I'd say tenant underwriting is something that a lot of people get lazy on.
Yeah, no, that's not just something that's in, I think, in commercial. As us being multifamily investors, I mean, it's also the tenant base that you're buying a property, and obviously a tenant base to their clients that are paying everything, right? And I think people kind of brush over that and they don't see the strength of that. And credit tenants usually something that's used mainly in commercial, but we'll use it as well in residential. And it's something that like, you just have to know that's the tenant base that you're going to be renting to. You know what I mean? You can't transform the property from a C to an A overnight or anything like this or at all. And it's something that's the tenant. You know what I mean? Maybe you go C to a C plus or C plus to a B minus tenant, but it's really similar that you're dealing with. And that's one thing you really have to understand, the risk that you're taking on with those people are the ones that are behind paying everything.
Absolutely. And it's tough because, you want to lease up your spaces. So I mean, on the residential side, if you're taking on a questionable tenant, but they'll start paying rent today, I mean, it's hard to pass that up for a potential tenant down the road, especially if it's a space that's sat vacant for a while. Yeah. But the damage they can cause, I mean, they're sometimes literally inside your home. Like it's a very, you're exposing a lot to them, and you're putting a lot of faith in them to, respect, your building and the finishes in it and everything.
No, that's one thing I had when going to third-party management after a few years of being self-managing myself. And that was one of the benefits, was that the property manager didn't really care too much about when I was paying the mortgage or whatever. If I had to put money into that account, they were making the best decision for the performance of the property. And that's much different when you have a mortgage payment coming up and you got, you know what I mean? And so it's like separating that emotion from what you know is right and sticking with it, which is not as much of an issue anymore, but it's something that one of the benefits of kind of separating that management from the ownership, I found as a kind of one of the other unknown or not talked about really benefits of having a third party manager.
So did you see that? Did you actually see better results, or was it just a nice emotional separation?
I saw better results. I remember it was probably like 6 years of self-managing properties. And then it took 1 year. It was literally 1 year for it to really show, you know what I mean? Just because they were putting in their own procedures of how they were doing it. It was kind of rocky for the first, I say 6 months. And then 6 months that first year, let's just say. And it was really after that. And then we saw it really come around. You know what I mean? That was our property manager that we had for that portfolio of properties before we sold them in 2022. But it was just one of those things where it was, I'd never had a third party manager before. So I was really new, and it takes so long. And when you hire a manager, I find it very interesting when people like change the managers really quickly. And it's like, even if it's a 1-year lease, it doesn't sound like that long, but even if you have just a few units, I mean, it takes years really for what they're doing to actually come through. You know what I mean? Because maybe you made mistakes with tenants. Maybe your tenants went bad. They're fixing those issues that you maybe had. And it's also, you won't know for years down the road of kind of what the product is. You know what I'm saying? So it's difficult to blame that property manager until you give them enough runway where they're able to really execute on what they're supposed to do, I guess.
Yeah, I mean, it's having management changes is a very slow moving vehicle. So I mean, I think you can't make those decisions too quick.
Yeah, no, for sure.
They're hard to unwind. And then the tenants, if they're seeing management changes, I mean, it gets them a little, spooked.
Yeah. It's not as bad as when you sell a property, but when the management changes, then you're just getting, you're dealing with every tenant one-on-one, you know what I mean? To make sure that, obviously more so with a tenant in the commercial sector versus a residential. However, it's something that, they're just worried about the one thing about, is my rent going up? You know what I mean? Which probably is going to hit a residential tenant a lot harder than maybe a commercial tenant for some reasons for that. So, but I don't know. It's just interesting when you're going through it. It takes a lot of time. And when you're changing management, you had to really choose that manager correctly up front, or it's a very time consuming process. You said from finding, from integrating, and from seeing if they're actually making a difference many, many years. Yeah.
Yeah. It is interesting how you're talking about, residential tenants, generally speaking, aren't making money, what you're renting to them. Where on the commercial side, since each tenant's making money within, those four walls, the rent increases, if you can justify them, are a little easier for them to swallow. And, that's why we try to do all these, capital improvements, so they can see that value is being added. We're not just, bumping it for the heck of bumping it. I mean, sometimes that's just the case because, inflation and whatnot, but it's a little different for the residential for sure.
What are some common mistakes you see retail and or kind of industrial real estate investors make?
So the biggest mistake I see is people make assumptions about what they can lease vacancies at that they put into their underwriting without understanding the depth of a market. And so we'll constantly see, if there's a strip center that has, 2,000 square foot bays, well, market rent may be $30 a foot. So they'll underwrite $30 a foot, that it's going to be vacant for 3 to 6 months. The problem is, without understanding, well, what specific tenants will want to lease this, and what's the tenant mix within the current retail strip center, who would complement it? Are those tenants interested in this market? Is this market growing? How is this relative to competitors? Those spaces can sit vacant for a long time. And so if you're overly optimistic on your assumptions rather than your in-place incomes, a lot of times people get burned. And this happens, if you have a few vacancies, but you're buying something that's, more value add, but it cash flows day one, you can afford that to some extent. But when people are buying deals that just seem like it's a good basis, without fully going through the full underwriting and understanding of, the downside risk if that tenant never comes, I've seen people, get caught and the carry starts to eat them alive. So that's a part of it. And kind of piggybacking on that is not underwriting an exit. So as I mentioned, when we are acquiring any property, regardless if we plan to hold it, for forever per se, we're finding out what the exit looks like in, 2 to 3 years, because we want to know that our plan actually is creating value and that the market would perceive it at that point. And then know that there is this exit where at that point we could say, okay, we were successful or not. There is value built in. So now do we want to sell? Do we want to refinance it? Or do we just want to hold and hopefully have a lower loan to value because we've increased the value, during that time period? So if you're incomplete and you just jump into a deal with, assumptions based on what the rents could be without understanding the market and not knowing what your exit looks like, you could find yourself, upside down just because you didn't really think through the various potential issues or strategies that can come from that.
No, that's a great answer. Are there any type of businesses that you don't like renting to, whether it's in your industrial or whether it's in kind of your retail? Are there any type of business types or anything like that maybe shies you away from investing in those properties or renting those tenants?
Well, there's the standard ones that I'd say, generally don't sell very well. Very unique uses. So like industrial would be uses that work with a lot of, I guess potentially environmentally risky materials. You're just opening yourself up to potential risks down the road, where if a tenant has a spill or creates an issue, and that's a lot of uses that work with cars. So auto body shops. We do that, but you just want to make sure you understand the tenant, and there be careful. Event spaces are really tough because the liability is massive. When you have an event space that you're doing for weddings or whatnot, if the economy goes sideways, you'll start to open that up to a lot of other things. As any business owner would, to succeed, or to stay afloat. So, we don't like those types of uses. Certain bar type uses, create more liability as well. So there's kind of a theme. It's like, is this use going to create liability? And is it going to create risk to the tenants next to it? So our tenant mix for every property, if it's multi-tenant, is really important to us, that they complement each other. So a lot of times, whether it be liquor stores, bars, auto, if it doesn't make sense to the spaces next door, then we won't lease them. That being said, we have amazing, bar tenants that we work with right now who, is great for the community. They mostly have food, but serve, great food and are just, overall amazing tenants. We have great auto tenants. So we will deviate, but then you really have to underwrite the tenant, a little deeper.
Yeah, the environmental is a very interesting thing. I didn't know if you were going to go that way. That's a great thing because I always tell people it's like whenever you're buying any property, always get that phase one because it's not just automotive. It's really, it could be dry cleaners. It could be something that was previously there too. It's such a newbie mistake of not getting any type of phase one, which most banks require it. However, if you're going and getting like seller financing, obviously the seller's not going to require it. You know what I mean? So it's just something that, you got to get that phase one because there could have been something there 2-3 businesses before that wasn't the best on keeping it clean. You know what I mean? So there's so much that comes back to you when you're owning that property.
Yeah. So I didn't bring that up earlier, but I should have. We're just so anal about it that I didn't think of it. It's just a standard. When we first put a property under contract, my phase one consultant I generally use the same group for almost everything, at least in the state of Florida. We're pretty friendly at this point. Because we're talking all the time. So they're one of the first people I talk to about a project, and they'll go and they'll look at the historic uses of that property even before I cut them loose. If I'm saying, hey, we're going to buy this thing, because they know that we're always going to use them for the business, and then we can get ahead of any potential risks. And we've had times where we were buying a property that we had a tenant in tow. We really liked it. It was a restaurant, and there came back pictures from, it was like the 50s. As you can imagine, satellite pictures back then were very, very blurry. But it looked like it was a gas station. And on this one, we were kind of unsure about it. So we kept on going down the due diligence process. We're pretty close signing a lease with the tenant, and we couldn't really figure out what was going on. So our phase one, environmental consultant, he drove 2 hours to the house of the lady who owned it at that point to ask her what that use was. And unfortunately, it was a gas station. So, this is one that we kind of let go further than usual. So we were a little nervous, about what to do going forward because there was no record of the tanks ever being removed. And so if you're buying a property with underground tanks still in it, and if there's cracks in those things, in Florida at least, because, the water table is below us, the aquifers, you could just have unlimited liability. We were talking about risk earlier, how you can quantify it. Environmental risk is really, really hard to quantify. You're making an educated guess. And that's an educated guess that, we don't want to play in that space. So we had to drill down and see if there were tanks down there. And it was nerve wracking. Luckily there weren't, and we were able to close. But generally speaking, environmental is just not something you want to play with regardless of the property. You just walk the other way.
And it's not the previous owner. It's going to be you as the current owner that's going to have to deal with it. And that's just, it can get extremely expensive.
Yeah. And sometimes that's why people will offer seller financing, because they'll know it. And so they'll think that a naive guy comes in and, hey, if they offer seller financing, they transfer it, to you, and then you own it and something comes up bad and, they got their deposit. Maybe they take the property back. I mean, they were in a bad position as it was anyways. So it can be a warning sign that we maybe double check to see what their motive is.
Yeah. No, perfect. Well, Nick, thank you so much for coming on today. We've gone a little longer. Can you tell us how our listeners can learn more about you and your company?
So you can go to our website, which is alakai-capital.com. And on there, you can reach out to myself or my team. We can jump on a call. As you can probably tell, we are obsessed with real estate. So we'd love to talk about it. If you have a deal you're looking at or want to talk about our process or how we look at things, we're more than open to do that as well. Or if you want to look at one of our investment deals, we're doing 10 to 15 deals a year. We syndicate every single deal. And, we have a phenomenal relationship with our investors. Right now, I think we have about 130 investors, and over 60% have invested 5 times or more with us. So, we really build relationships, and I think our returns are get people excited to want to come back. Or you can find me on LinkedIn. If you go to LinkedIn and type in Nick Jones Real Estate, you'll be able to connect with me and send me a message, and I generally respond to all the messages I get.
Fantastic. We will put the link into the show notes, and I want to thank you so much for coming on today, Nick.
Thank you. I've had fun.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.